Believe it or not, this is a very controversial subject. Today I'm going to explain what a stop loss order is and tell you the hard truth about them. It's pretty much a guarantee that I'm going to end up offending a few people with this one. But in spite of probably getting a lot of hate on this one, I'm dedicated to my mission of putting out quality information for the beginner investor out there so that you have the information that I wish I had when I was starting out. Okay, so let's just get this out of the way. Investors do not use stop losses. Traders use stop losses. If you currently use stop loss orders and you consider yourself to be an investor, I'm sorry, but you're not an investor. You're a trader. Yes, this is totally just based on my definition of investor, and everyone can have their own definition of investor, sure. Why not? I think what has happened here is that people are tying their definition as to what determines whether you're an investor or a trader to one's intended holding period length, and that's wrong. I will explain what I think makes somebody an investor. However, we're getting a little ahead of ourselves here because I still need to explain what a stop loss order even is so that we're all on the same page. With that said, if you want to keep the horse blinders on and close this video, then go ahead. But if you're a seeker of the truth and you're okay with re-examining old beliefs, then just hear me out. The best way to explain a stop loss is with an example. So let's say you buy a stock for $20 per share. A stop loss order would mean that simultaneously, or really anytime afterwards, you go ahead and you put a sell order in at a price somewhere below your $20 purchase price. Maybe you put it in at $18 or $15 or even $10, wherever you put it, it doesn't really matter. The point is that you put a sell order in so that in the event the stock that you bought goes down, you're able to automatically sell it out at a set price. People that use these stop loss orders would say that they're doing it to limit their risk. So their goal is to quickly and automatically sell the stock that they just bought if it goes down, so as to save themselves from experiencing an even larger loss should it continue to go down. They might say something like, I'm using a stop loss here, so that way if I'm wrong, I only lose 10% instead of losing 50%. In addition, these users of stop losses, oftentimes, if their stock goes up in price after they've bought to, let's say, $25, well, they might raise the stop loss order to the $21 price level, for example, to lock in profits. There's even something called a trailing stop order or a smart stop that automatically moves up as the stock price continues to move up to further continue to lock in profits. Now, on the surface, to a beginner, I can see why this could sound pretty logical. However, the idea of using a stop loss order is built on a very bad foundation. And for that to make sense, let me now explain the difference between an investor and a trader, and you'll soon see why. Here's the difference between an investor and a trader. An investor, first of all, recognizes that buying shares of stock means buying a percentage of the underlying company's ownership. Most people don't actually realize this. They might loosely understand that there is some kind of connection between the stock and the company, but they don't realize that it's a very exact and mathematical relationship. And secondly, and equally as important, an investor would only buy stock if they felt they were doing so at a price that made it an investment that had a positive net present value. And for net present value, I think Investopedia's definition is nicely worded. A positive net present value indicates that the projected earnings generated by a project or investment in present dollars exceeds the anticipated cost, also in present dollars. It is assumed that an investment with a positive net present value will be profitable, and an investment with a negative net present value will result in a net loss. So that's how an investor thinks about and buys stocks. A trader, on the other hand, ultimately just buys because they think the price is going up. And that's really it. The trader might say something like, I like this company, I think it has a great future, so I'm gonna buy it. And that's that. Maybe they have some extra rationale in addition to that, like the price has gone down recently and therefore if I buy now, I'm getting it at a good price. However, that extra rationale doesn't make it any better. And it doesn't make them any more of an investor, even if their intention was to hold forever. Traders most commonly buy stocks based on price, based on hype on social media, based on other recent news being released, that sort of thing. Now, I do want to stay on the subject of stop losses and managing risk in this video. However, if you want to understand how to actually calculate the net present value of an investment, you should check out this video here and this video here, probably in that order too. And I'm going to link to a playlist in the corner of this video here and also in the description below if you want to check those out. Now, by the way, on that note, I want you to know that I'm not saying that to be an investor, you actually need to do these precise calculations all the time. Warren Buffett and the rest of the value investors of the world don't necessarily do a calculation like this, but what I am saying is that it is exactly what they think about. So this is how they think about it, and if you read any of their books or watch any videos of them speaking, you'll soon realize this. An investment having a positive net present value is everything. So therefore, at least understanding how the calculation is done is an important step in your investing journey. Also, for those of you that need to hear this, please don't get intimidated because there's some math involved. Being a great investor does not require you to be really strong in math, nor does it require you to be great at using spreadsheets either. Most value investors don't even go near a spreadsheet. All you really need to understand is that the value of a business is based on how much cash it will be able to generate for its owners in the future, and that by owning shares of stock, it makes you one of the owners. Just the same as how traders and investors have different reasons for buying, they also have different definitions of risk. To a trader, risk has to do with volatility. To them, the more volatile a stock is, the more risky it is, and therefore a stock which has historically been prone to large price swings is now considered to be a more risky investment. To the investor, on the other hand, well, this definition of risk is a complete joke. The true investor welcomes volatility with open arms. For them, the price dropping in and of itself does not signal anything bad. Actually, it's very often a good time to buy more. I like this quote from another legendary investor named Howard Marks. He wrote, "No asset is so good that it can't be bid up to the point where it's overpriced and thus dangerous. And few assets are so bad that they can't become underpriced and thus safe, not to mention potentially lucrative." And here's Warren Buffett's definition of risk from his 1993 letter to shareholders. "The real risk that an investor must assess is whether his aggregate after-tax receipts from an investment, including those he receives on sale, will, over his prospective holding period, give him at least as much purchasing power as he had to begin with, plus a modest rate of return on that initial stake." He goes on to say, "Though this risk cannot be calculated with engineering precision, it can in some cases be judged with a degree of accuracy that is useful." I particularly love that definition because it even accounts for taxes and inflation by referring to purchasing power. So here's the deal. The cheaper a stock becomes relative to its intrinsic value, not relative to its historical price, that part's irrelevant, but relative to its intrinsic value. The cheaper it becomes, the less risky it becomes as an investment. Pick any great company, Coca-Cola, Apple, Microsoft, Amazon, Facebook, it doesn't matter. Let's say that the stock's price is currently trading at $100 per share and you've roughly calculated its intrinsic value to be around $120 per share, and you've roughly calculated that by purchasing the stock at $100 per share, you should expect to receive around 10% annual returns. If that stock were to proceed then to drop in price by 20% down to $80, it actually becomes a less risky investment. Buying it at $80 would give you more of what Warren Buffett's teacher, Benjamin Graham, referred to as a margin of safety. And if you had purchased it at $100 per share and it then subsequently dropped to $80 per share, well, as an investor, you would not be jumping to sell just because it's gone down. And that's because the stock's price action in and of itself should have no impact on your belief that this stock has an intrinsic value of $120 per share. Investing with a margin of safety was actually Ben Graham's #1 most important investing teachings. His second most important investing teaching was his concept of Mr. Market. If you don't yet know the analogy of Mr. Market, or you don't yet have a very complete and thorough understanding of it, then I'd highly suggest you watch this video right here sometime in the near future, because it's what Warren Buffett says is the most important concept for new investors to learn. I want to leave you now with a quote from my favorite investor of all time, Charlie Munger. First though, a quick reminder, I'm not a financial advisor, so please enjoy my content as entertainment and not as financial advice. Okay, so here's what Charlie Munger says.
In fact, you can argue that if you're not willing to react with equanimity to a market price decline of 50%, 2 or 3 times a century, you're not fit to be a common shareholder, and you deserve the mediocre result you're going to get, compared to the people who do have the temperament, who can be more philosophical about these market fluctuations.
So how do we gain what Charlie Munger's talking about here? Well, for one thing, it's to understand what we're buying and what it's worth before we buy it. And then secondly, it's to internalize this lesson about Mr. Market. If you click on this video here, it will take you directly to that video to watch it next. And if instead you're curious now to find out when exactly an investor should sell their stock, well then you can check out this video right here.